let's get started.
Hi, everybody. Welcome to the monthly market insight for December. It's the end of the year, so kind of what Sean will walk us through are how the market's performing. I know in the media throughout the year, we've heard a lot of negativity, which is certainly common. The media obviously likes to push that and fear in everybody. So a lot of information around inflation, what the Fed's saying on interest rates. Sean, can you kind of like push all that aside and really just bring us the data on how the markets are performing? We'll kind of start with that.
Yeah, absolutely. So we'll certainly talk about the markets. Right now, markets have been moving pretty positively, and that is because of what has been happening with interest rates, and more importantly, what happened with inflation in November. So you saw inflation drop from 3.8 down to 3.2%. The markets really liked that and thought, you know what, maybe the Fed will stop raising interest rates. So December is going to be a big month. It feels like we've been a broken record talking about this, because this is what has been moving the markets really for the last almost 20 months now, is what is happening with unemployment, which we will get that number on December 8th. If that remains to not increase and it does not decrease, then that could be really positive. If it starts to decrease, then the Fed may say we need to raise interest rates again. We still have some room to do so because the Fed's target for inflation is still 2%, and we're at 3.2%. So if they feel like they can raise interest rates again because unemployment has not increased, then we may get another interest rate hike. So that is the first number that we're looking for in December. And then on December 14th, we're looking for the next inflation number. If inflation falls below 3%, or if it falls from 3.2%, again, another sign that the Fed may not raise interest rates, or they may start to lower them. And all those things are what's causing the market to go up and down. And we'll kind of look at how all that is doing. But that is really what's been going on in the market. And that is why November was such a great month. And so far, December has been off to a great month, is because people are starting to see that inflation's coming down. I know I filled up my car at under $3 a gallon. So we're starting to see these things in our own lives. Groceries, some groceries, not all groceries, have come down a little bit. And so people are starting to see kind of things return to the mean. And so hopefully that is reflective in the data. If it is, then the markets could continue to be positive. All that being said, if the data is negative and we see jobs are lowered and inflation goes up or remains the same, we could see the Fed raise interest rates, and then we'd expect the market to pull back, because the market's pricing in that, hey, we're not going to see any more interest rate hikes. So still a lot of unknowns, right? The market could end up pulling back and it could be a negative December, or we could get some really good data and the markets in December could take off. But so far, it's been a good year. We'll kind of look at that. Kind of answer your earlier question, Nora, kind of some of the things that we've been doing for clients really towards the end of the year here. Are you seeing my PowerPoint, Nora?
Yes.
Awesome. So we've got kind of end of year planning that we're doing with people. So required minimum distributions, the way those work, if you're over the age of 73, or you've inherited someone's IRA, a parent, a relative, a friend, if you've got their RMD or their now their former IRA or 401k that you've rolled into an inherited IRA or a Roth IRA, then you're required to take money out every year. So one thing we're doing with clients is making sure that they've fulfilled that obligation, because the penalty is pretty steep. It's about 50% of the value that you should have taken out. So we want to make sure clients aren't doing that. So if you don't have someone looking over your shoulder, make sure you're doing that. Or if you want some help, please reach out to us. But we've been focusing on that really the last month or so. We're also doing
real quick, before, just on the RMDs, can you clarify? Obviously, you have your retirement plans, individual retirement plans, your traditional IRAs, and things like that you have to take RMD for. But if you inherit, if a parent passes away or something and you inherit, what are the rules specific? I know you mentioned there is a deadline to take those RMDs, but tell us what that length is, just to clarify.
Yeah, absolutely. So it really depends on when the person passed away. The rules changed in 2020. So if they passed away before then you can use that IRA and take out an amount based on your life expectancy. If they passed away recently within the last couple of years, then you have 10 years to take out that money. So what we do with clients, we set up a strategy to make sure we're taking out a certain amount. As an example, if someone passed down $500,000 to you and you said, hey, I want to go buy a vacation out with that $500,000, and it was in an IRA, and you pulled that money out you could do that, but you're going to have to pay taxes. And now it looks like you just jumped into a new tax bracket, because say your income was at 100,000, now you took $500,000 out of an IRA, now your income's at 600,000. So you just jumped up into the highest tax bracket. So what we do is we come up with a strategy, say, let's take out a certain amount every year based on what your expected income growth will be in the future, what your plans are, what your goals are, so that we can navigate that with you. So that really determines when you have to take out your required minimum distribution. But more recently, it changed to you have to take out the full balance, whether that be traditional or Roth, within a 10-year time period following the date of death. If it's before that, then you can use that money and pull it out over the course of your lifetime. So a lot of things to navigate. It's really challenging. It's one of the unique planning things that we continue to see more and more. And ultimately, we're going to see a lot of it in the future, because IRAs, 401ks were built in the 1970s. That's when they were created. Baby boomers and people in that generation are starting to pass away. And so their family members are going to be inheriting this money, and there's some very unique tax challenges with it. So those are some of the things we've been navigating with people. Additionally is kind of some tax planning. So we're doing tax loss harvesting. What that means is in brokerage accounts, investment accounts, selling some positions that may be discounted so that you can recognize a loss. And really, with our clients, we're doing this at the beginning of the year, making trades so that there's a loss, so that when the markets bounce back, which we were expecting, and they did in 2023, which is probably more luck than anything, but really kind of an outlook that, hey, the markets were discounted, let's go ahead and take some losses. We moved into a different position. Now the markets come back, you get the gain, but you got to write off a loss in those accounts. Now, you can't do that in IRAs or Roth IRAs because none of that's taxed until you take it out. But for brokerage or investment accounts, that's something that we've been doing, and make sure we got it right and navigating that with CPA for our clients. Also updating 2024 automatic contributions. So again, we're going to go over the IRA limits, 401k limits, but that amount increased for people under the age of 50 from 65 up to 7,000. So just making sure that they're all squared away so don't get hit with a big surprise at the end of the year. And then we're doing backdoor Roth IRAs for clients. As a reminder, if you're single and you make over $153,000 in 2023, you can't contribute to a Roth IRA. So we put that money into a traditional IRA, and the next day we move it into a Roth IRA. We do a Roth conversion. And if you're married, income over 228. And then you can kind of see the 2024 numbers. Single goes up to 161. Married goes up to 240,000 in 2024 So good.
What are some of those deadlines for people looking to either complete their Roth IRA contributions via backdoor or directly to the Roth? What are the deadlines for 2023?
You have all the way up until you file your taxes. And then great transition for me, Nora. Thanks. Yeah, the tax filing deadline for 2023 is April 15th. So ultimately, you can do it all the way up to April 15th. But if you file your taxes early in March, you just have to make sure that your 1040, work with your CPA to get that done, accounts for that Roth conversion, the non-deductible contribution to your traditional IRA. But ultimately, you have all the way up until April 15th to do that. For us, we like to make sure it's done on an annual basis. And so we're just following up with clients in that regard. Again, for taxes, IRA contribution for 2023 is $6,500, the $1,000 catch-up. 401k is $22,500, the $7,500 catch-up. In 2024, those numbers increase. The IRA goes up to $7,000. The catch-up remains the same. And the 401k goes up to $23,000. The catch-up remains the same. So again, kind of some good things to think about for 2024. Tax filing, tax preparation, and automatic contributions to your 401ks and IRAs.
Awesome. And then real quick, just to clarify with the 401ks that we work with clients on, is that's obviously pulling from your paycheck, right? Per pay period. So make sure if you want to max that out for 2024, you're either doing that starting in January and doing that for the remainder of the year, or you're going to be taking out more money to max that out towards the end of the year. Just note that the Roth IRA is a little different than the 401k in terms of pulling and when those deadlines are.
Yeah, that's a great point, Nora. So any money that you put into your 401k must be done by December 31st, because as Nora mentioned, it's a payroll deduction. Your employer can still put money in there for employer contribution, but you have to get your money in there by December 31st from a payroll deduction. IRAs, you can put all the way up until you file your tax deadline. So IRA contributions can be past December 31st. 401ks typically can't. All right, so how are the markets moving? So let's take a look at kind of January 1 January all the way through how things are going today. So the NASDAQ, or the position that we use as an index on our NASDAQ, is the QQQ position, is up over 40% for the year. Right now, everyone's like, well, I don't have all my money in that, right? So in 2022, that also had the biggest loss. Okay, so it drastically underperformed. So it has what we call a higher standard deviation, more risk in it. Tech companies have been doing well. We've talked about this, be it because of some of this AI generation and potential outlook on that market. A lot of tech companies have been cutting people. That usually results in a positive outlook on their shares. But tech companies, we talk about the Magnificent Seven, kind of the largest companies in the S&P 500. You know, your Googles, your Amazons, your Metas, Apples, those kinds of companies have been doing extraordinary. The rest of the market has been kind of ho-hum, right? And we can kind of see that. So we have our S&P 500 in light blue. That's the position that we use for that index. You can see that's doing really well, but really these companies, the tech companies, the Magnificent Seven, are pulling up the rest of the market. So the S&P has done very well. Small value, right? Those are going to be maybe your Hobby Lobby versus your Home Depot or your First Trust Bank than your Chase Bank, things like that. They're going to be a little bit smaller. You can see this kind of represents the rest of the S&P 500, if you will. And again, that's not a fair comparison, but kind of shows you that the rest of the market is doing fine, but it's not been a great year for them, even though they've had really, really great earnings reports and things like that. There is still some uncertainty on how interest rates will effectively move over the future, and that's causing kind of some of the bottom tier companies to not have as good of a year as the tech companies. So as interest rates have come down, tech companies, I shouldn't say they've come down, as that started to stabilize and the outlook has got a little bit more clear, tech companies have done really well. And then small value companies and the rest of the S&P 500 are just kind of going along okay. Additionally, we have a bond position. This kind of represents the aggregate bond position, is still down for the year. And that's because bond prices and interest rates are inversely correlated. So as interest rates have continued to rise, bond prices will fall. The good news is, if and when the Federal Reserve lowers interest rates, those bond prices are going to go back north. So it could be a really good time to be in the bond market, especially because the bond fund managers are now buying new bonds inside of that fund that are paying a higher coupon. They're getting some of the 5, 6, 7% bonds that are available, and they will have those for the next 1 to 7 years or so. So they're going to have higher coupons coming in, and as bond prices fall, then I should say as interest rates fall, then bond prices will rise. So it could be a really good time to be in the bond market, depending on what happens with the Federal Reserve and when they raise or lower interest rates. So that still has a lot of volatility in it, but you can see around that November time period, it has done extremely well, and that is because we're starting to get some optimistic data to show that inflation's coming down. We anticipate the Fed starting to lower interest rates. So we'll see how that evolves over the next coming months. But kind of gives a story about how things have been going throughout the year. It has been a crazy year, right? So we had a really good start to the year, a big pullback through March. You can see kind of things went along really great. And then we got some scary news about interest rates and inflation. We saw the markets pull back. October was an awful month. And then November, things have really taken off all the way through the start of December. So we'll kind of get some data here coming in December. December 4th, we'll get the jobs number. December 8th, we'll get the jobs number. December 14th, we'll get the inflation number. We'll have a little bit more clarity, and it could either be a great finish to the end of the year and really cap off a really strong year when you look at things in general, or we could see that inflation stays the same or increases, and there's a little bit more uncertainty about what the Fed says. The Fed could also just come out, because anytime they talk, we also get a little bit of fear, a little bit of movement in the market. So if the Fed comes out and says, hey, listen, I know inflation's going down, but I don't really care. We're going to raise interest rates. You can expect that, because that is what they said back in October. They said expect interest rates to remain around the 5.5%, 5.25% range through 2024. The markets didn't like that. We got a great inflation number in November. Markets took off. So a lot of things can impact the market, but it's all kind of a guessing game. What we do know is that no matter what your strategy is, right, it should be to stay in the market, especially when investing with us. We have a diversified portfolio between all those asset classes. We're going to be in the market for the long term, and that's what we're investing for. So our goal is to reduce cost find really, really high quality, low cost exchange traded funds to achieve those goals. And if you go back and look at things from the, over the last 22 years, and this includes things like 9/11 kicking off, the 2008 housing market crash. You've got the 2015 market pullback due to China uncertainty. You have 2018 when the Fed tries to raise interest rates and Trump and China got into a little bit of a trade war. You've got 2020 coronavirus. You have the 2022 rapid rising interest rates plus rapid inflation. So you've got a lot of activity, a lot of pullbacks in the market along that way that were really scary. And things that we've been hearing from clients really through the last 2 years is people being scared, wanting to get out of the market. And ultimately, what I hope these charts have shown from both the last slide and this slide is, right, the way that we invest, staying in the market, creating a diversified portfolio. If you stay true to it, you're going to get unbelievable results. And that's exactly what's happened over the last 20 years, over the last year. And we'll kind of look at our portfolios over the last couple of years. And so Bolt performance since 2019, our conservative portfolio up about 3%, moderate portfolio up about 7%. Our growth portfolio is up a little bit over 8.5%, and our aggressive portfolio up over 11.5% after fees. So, there's a lot of uncertainty. Again, you can see in 2022 is an awful year, but if you stay invested, that even through that volatility, you're going to get the results that you should if you buy high quality, low cost funds and stick to the game plan. So that's ultimately what our strategy is at Bolt Financial Group. So that kind of concludes everything we want to talk about. Are there any questions out there right now?
I don't see any questions on here. I'm not sure if we're on Facebook Live, but we'll definitely post this video on Facebook. So feel free to either message Sean or I, or just comment on the video if you have questions. One of the things that we do talk to clients about, when Sean, if you want to go to that last slide and we talk about performance, is everyone's like, oh man, I would love over 11.5% return, right? But when Sean and I work with clients, is making sure you're in the right risk tolerance, the right portfolio, right? We have a lot of clients that are like, I really don't like risk, but I want 11.5%. Well, you're going to have to take on some volatility and some risk, but our main goal is making sure you're in the right portfolio. If you're not, we didn't do our job, right? So this is, again, it's just from 2019, but you can see everything. You're not going to get 11.5% return every year, year after year. So that's one of the things we kind of talk about. If you have questions on that, especially as you get into 2024 planning, please reach out to Sean and I. We're happy to kind of be a resource for you and just provide some data and context around some of the decision making, so you can have a better, well-informed decision as you get into 2024. For clients, if you have questions on what your contribution limits are, do you qualify for a backdoor Roth, please reach out to us. That's what we're here for. We'll see you back in 2024. And so if you have questions up until then, reach out to us. Have a good end of the year.
Thanks, everyone.